Hey, everybody. Good afternoon or good morning, depending on where you're at. This is Glenn Setchfield, VP of Marketing for DMI. Welcome to today's DMI University webinar, Double the Par Rate, Drop the Volatility. So today's conversation is built around a challenge that many advisors are facing right now. How do you keep clients interested in S&P 500 linked strategies without getting stuck defending low par rates, renewal uncertainty, or volatility that's hard to explain? That's why we're excited to dig into the new S&P 500 Distance Stabilizer Index, which is a strategy designed to deliver participation rates up to 112% and help create steadier renewal conversations. And I'm really honored to say that leading us today is Tom Haynes. He's the EVP of Capital Markets. This is in case you don't know, the EVP of Capital Markets and Index Solutions at Annexus. And again, if you don't know it, Annexus is available to less than 1% of the advisors in the country and tend to gravitate to larger cases or convert into larger cases their product portfolios. So um, we're really proud of our Annexus relationship. And so Tom doesn't just talk about indices; he helps to build them. He's played a major role in developing some of the top performing indices in the FIA space, including the award-winning NYSE Zebra Edge Index. And then joining him from DMI is Eric Lindewall, our VP of Annuity Sales. And Eric brings 35 years of experience across advising, sales leadership, and annuity wholesaling. He knows how to turn complex strategies into client conversations that work, and he keeps proving it over and over again on our webinars and also with the clients that he supports. So today we're talking positioning, strategy, renewal conversations, and how to lead with more clarity in a crowded FIA market. With that, I'm going to turn it over to Tom and Eric, but let's start with Eric. And just wondered, Eric, if you had any thoughts before we kick things off.
Thanks, Glenn, and good morning or afternoon, everyone. We appreciate you taking time out of your day to join us today. And today's really a special event. We're really honored and blessed to have Tom with us today. I talk to advisors all over the country every day, and the conversation around fixed indexed annuities has really evolved over the past few years. There are so many index options available and strategies available in all of the products that we have access to. And there's been this evolution from broadly diversified risk managed indexes, which certainly have their place when they're built correctly by folks such as our friends at Annexus. But really, over the last couple of years, many advisors that we work with have been asking for sort of a simpler, purer approach. Name brand recognition, indexes that the clients understand, and that really means the S&P 500. The challenge we've had is that you can access those index options via a participation rate approach or a cap approach. And there's some inherent challenges with both of those approaches. Participation rates, generally speaking, are difficult to sustain and have a really compelling participation rate to start. And cap strategies, while there's a lot of teaser caps out there, are very difficult from a pricing standpoint to maintain. That's where the folks at Annexus, in partnership with Societe Generale and S&P, came in and built this innovative strategy where clients are going to have an opportunity to really capture a significant portion of the S&P performance without some of the challenges of volatility control and pricing constraints. So this is new, this is innovative, and most importantly, it's exclusive. You can't get this in a lot of places. At DMI, we're really proud and really grateful to be one of a select group of insurance marketing organizations in the country that have access to the Annexus portfolio of products. Simply put, they build the best stuff in the industry. So we're really glad to have Tom here today to walk us through the Distance Stabilizer Index. I think you're going to find that this is a game changer. So with that, Tom, welcome. Thank you for joining us, and take it away.
Well, thank you so much, Eric, and for all your advisors taking time out of their practice to be a part of our discussion today. And yeah, we are pretty excited about this. The S&P Distance Stabilizer currently is available to you on our Athene BCA product, which, by the way, a 20-year partnership continues. And this is so topical that we've been able to bring in stabilizer coupled with our academic portfolio, as well as on our North American product. You'll see it all continue to really be on our line because of really what you just said. How do you bring S&P in a structure that we're not going to have a rate renewal roller coaster? And that's easier said than done. So for today's discussion, I'm actually going to utilize our slides for our Athene BCA product. The product, again, as I said, you have access to, and I think it really shows what the stabilizer is able to do within an accumulation engine, and then how it complements the rest of the portfolio. So what I would do is here, I have my slide up. You're going to work with your sales directors at DMI as well as your marketers there to really go through what the BCA product is, right? And when you think about it, having a 15% bonus where you still, for just 85 basis points, have some of the leading accumulation rates in the market just is unheard of, right? For 14%. The ability to have tracking values daily, the FER rider, and then this whole academic portfolio here. They have, not that we're just getting on and saying we got the S&P Distance Stabilizer, best S&P design in the country, but rather that we're still committed to our academic portfolio, which includes the best product return in the US right now, being the global Shiller. Your clients are getting nearly 40% product returns, which still at the end of the day, our goal of the Nexus is not to chase returns on one specific index, but how to bring a portfolio, an asset allocation model, so that long term, you're giving your client the opportunity to maximize the probability, getting 5-6% returns on a 10-year chassis with 100% downside protection. That's our goal. We're not trying to be an equity replacement here. We're trying to be a better all. And when you hear the narratives, the data that arguably we still are in the worst bond market in U.S. history. Here we have just seen yesterday the 30-year bond hit the highest level in 20 years, meaning bonds are not a safe asset. And knowing that you can gravitate to an FIA with 100% downside protection and with the versatility of our lineup, really, I think it's comforting to allow you to adjust your clients to their sleeping point. So the S&P 500 Distance Stabilizer, I think Eric summed it up really well. At a Nexus, we were the first to come out with an uncapped S&P design in 2005, 2006 on the original American Investors products, multi-year. Then to couple that down with tracking values daily. However, what we began to see is you still have the rate renewal issues. You have the rate renewal issues, which I'll hit upon because of higher interest rates, higher volatility, lower dividends. And unfortunately, these aren't our partners, but the scenarios where actuaries and chief financial officers at insurers put you in the Roach Motel with a teaser rate, and then you're not able to explain why is the renewal rate going down. Who here has seen renewal rates actually going up consistently on S&P designs? And then when you think about it, in 2012, after the lost decade, so many zeros in the lost decade, and then having a rate renewal roller coaster there, we really began to gravitate. And that's where I entered the industry to bring in smart beta, is what we'll show today, academic beta. We did it in a way in a low rate environment, a way to diversify and complement the S&P. While over all those years, we continued on our Athene product, for example, to have the S&P as an offering. But even that had a rate renewal challenge. So hence why we had our S&P strategies there, but really built upon our smart beta offering. So how could we bring S&P, though, to the market? I have S&P in my 401k. I have S&P in my IRA. Many of you do. But how do we do it in the efficacy that we're not going to have to apologize to our client? And that's really what the S&P 500 Distance Stabilizer was able to bring. Being boots on the ground here, representing you, the advisor, we actually have the biggest purchasing power on Wall Street of smart beta strategies. The $35 billion that we sent Wall Street gets us the first look at new indices. It gets us the executive accountability. And it's funny, the insurance industry, the index annuity needs Wall Street. It needs Wall Street to help manufacture these solutions. But yet I'm the only person on Wall Street representing the insurance industry. So by having that opportunity, being boots on the ground, being the only executive team member of a Nexus, not in Arizona, I actually had the opportunity to meet with the leadership at our investment banking partners that really want to help further solutions. And last March, I received a call from Societe Generale. We've been working with them for a number of years. They've been in the markets business for over 35 years, and they said, we have an S&P design we would like to show you. Got on the train, showed up their offices on a Monday morning, early in March of 2025, and what they were able to show us is what is now today the S&P 500 Distance Stabilizer Index. Utilizing their prowess and know-how in the trading of hedge funds and budgeting for S&P, they were able to construct this design, and from there, we were able to partner with S&P, and exactly right, this is exclusive to Annexus. We at Annexus have an agreement in place with Standard & Poor's. We have an agreement in place with Societe Generale. So we're excited that this is what we're seeing live performance, the best performance of an S&P offered to us. And knowing that, yeah, would there be a knockoff maybe down the line? Perhaps, but to have the official S&P version, we're really proud about to bring that to you. So what are we talking about here? We're not talking about vol control. There is no vol control. None of that. No bonds, no commodities. We're not talking about an index as hidden caps or excessive leverage. None of that. No shorting. What we're aiming to do is a new structure, the design, that when the S&P zigs, this zigs. When the S&P zags, this zags, because it has the efficacy of demonstrated 100% capture on average of the S&P returns over the last 30 years. Without having the rate renewal mess, without having the rate renewal roller coaster. So that's what we're talking about. No vol control, no bonds, no commodities, and aiming to capture, which we demonstrated historically, and I'll walk through, 100% returns of the S&P over the last 30 years. So if you look at this slide, this is from 1996 to 2025. When you see the S&P rolling returns, this is the S&P 500 price return, the rolling price return returns, the benchmark for the FI industry, obviously removing dividends. And really what our clients want, what you as an advisor wants, is how can you provide 100% of the upside, but with 100% downside protection? That's the goal, right? How we can bring that to our client, and obviously that doesn't exist. What we've been faced with an S&P 500 participation rate design, and I could share the same thing with caps, is let's take the last 10 years. If we were able to issue 50% participation rate on an S&P 1 year point to point 10 years ago, using the real options mathematics, not the teaser rates, but truly looking at historical volatility, historical rates, and so forth, this is what you would have had happen. You would have actually seen your renewal rates going down to 39%, 40%, all the way down to 28%. And odds are, how many insurance companies would even come back in the end and increase the renewal rate? Very few. This is coupled with the best equity market we've seen in decades, and it would have then captured a double-digit return to be very disappointing, where you have rate renewal discussions that are hard to articulate and leaving your client with, let's say, a 5.5% return, which is a good return, but a confusing one when we saw double-digit returns, because you're not capturing S&P on an average of less than a 50% participation rate. So going back to the slide we showed before, this is the S&P 500 that would be, let's say, in your funds, your asset allocation model. Price return now, 763 average return over rolling 2-year periods. But how can we bring in all the upside with the downside protection? How can we capture that? And that's really what Stabilizer has been able to do. By having the FIA design, we have the 100% principal protection, which is key to be that better all. But how do we provide an upside with the efficacy and not having the rate renewal roller coaster? What we've been able to do with the S&P 500 is, instead of giving you on average FIA product return of 569, we're able to, with the distance stabilizer, to capture on average 100% of the return of the S&P by taking out all the downside, taking out the tech collapse, taking out the financial crisis. Taking down that downside is a huge help, but with the stabilizer design, with the budgeting, not vol control, but the budgeting of the S&P, we're able to bring in 100% participation over a 2-year term to capture on average is 765. Capture. That is the word I want to leave you with when we think about the S&P 500 distance stabilizer. It's aiming to capture over the long term on rolling periods 100% of the S&P price return index with 100% downside protection. So instead of having the rate renewal roller coaster in the slide that we reviewed, how do we think if we could have a new issue money rate of 100% on a 2-year structure? But as we have demonstrated for the last 13 years with Smart Beta and the Nexus, to have rate renewal stability, 100%, 100%, 100%. These are not contractual in the contract. That would create more reserve strain. But you can see with what we have demonstrated over those years, how we're batting 1,000% rate renewal stability with Smart Beta designs, and you'll see the same with Stabilizer. I can share that Societe Generale with Athene, with North American, has in place contractual trading obligations. So hence, the insurers would be able to aim to provide that stability that really what your client wants. So instead of having on average a 44% S&P par rate or cap rates, let's say that are starting at 10 and there are teaser rates that come to 4, or guaranteeing, let's say, a 7.5, which pales, or going to a 55% 2-year participation rate with S&P with renewal risk, how we can bring 100% participation rates with no fee with the S&P 500 distance stabilizer. Pretty powerful to say that you can get your clients on the line and say, hey, Mr. Jones, Mr. Smith, I have a S&P design that can bring you 100% participation rate. Would you like to learn more? And then from there, to be able to show the capture rate of what this is able to do and how powerful that is. So when we think about the last 10-year returns, if you had on average an 6.1% cap, that would give you 6%. And that's not even with the rate renewal discussion. Or an average 44% par, 644, with a distance stabilizer using the back-tested data, including now almost 7 or 8 months of live performance, we have a 10.5% annualized return, product return to the S&P. A much better capture rate, hence to our point that we showed earlier. And that's without a fee. The other thing I'd like to transition to, though, is our academic portfolio. So you can see from there that live performance, especially if you just go on S&P's website now and see the live performance, it's phenomenal. Clients are getting over 20% product return with that structure. And on Nexus.com, the DMI team can provide you and get access to the presentations, the fact sheets, the materials, as well as on S&P's website. They have brief sales piece as well as a technical drill down that are open, publicly available, and we're really proud of that partnership. So we have the leading S&P returns in the market. And that's what many clients want, to Eric's point. However, what happens if we have another lost decade? What happens that we've seen over the last few months where the S&P isn't there? Wall Street thinks for the next 10 years, the S&P is probably going to price return 5.3%. Now with AI, geopolitical issues, it's hard to tell. Are we having a 20% return maybe in the next year or two? Do we have a negative? But when you think about the long-term performance, how can we then take the leading S&P design in the FI marketplace so it's there and anchored in our product, but we continue our commitment to working with academic portfolios to bring in an academic portfolio, not a shiny object one index, but taking the best minds such as Jeremy Siegel and his best friend from MIT and our first index partner, Robert Shiller, who've demonstrated top product returns. As many of you have heard over the years, the story of the Global Shiller Index. When Bob asked us to mandate that index and launch it, in 2019, it had a 2.6% illustration. And now that we see over the last year, 40% returns near, which is above and beyond what we're trying to do. We're trying to do a 5, but knowing there are years we have other strategies doing 0. So how do you bring this academic portfolio so when the S&P zigs, this can zag? How within the portfolio you have different indices when they zig and zag of strong academic foundation, it drives and maximizing the probability of a 5-6% return. So as we work to put the stabilizer on the Athene BCA product in November, we also had the opportunity to expand our academic Mount Rushmore, to have the only 100% academic portfolio in the market. Working with Cam Harvey of Duke University, Director of Research at Research Affiliates, and really one of the most cited live academics in the marketplace with his research covering all asset classes. And then DMI is a Boston-based shop, bringing in Ronnie Sadka, the chairman of Boston College's finance department, and really a pioneer in looking at how narrative media drives the market. Said another way, how you can bring news and look at news to asset allocate. So those that follow the news, your clients might know who Jeremy Siegel is. He's on TV once a week on CNBC. But what I would highlight is when your client is able to go home and research you, these are impeccable reputations, from the Nobel laureate Robert Shiller to the greatest stock line live Siegel to Harvey and Sadka. And this independent mindset, this is the only 100% academic portfolio in finance. Dimensional funds have academics, but they think alike. They're the same organization, but having diverse mindsets and bringing them together in an asset allocation portfolio. From Shiller Global, which we said the leading FIA global allocation in the market, to having a way to look at the US market with his quality and value, which, by the way, has not done as well the last few years. Jeremy Siegel, best performing FIA product return in 22, clients getting nearly 20%. And then actually during the Mag 7 era, kind of struggled. But now you're starting to see that come through as we see a rotation, a double-digit returns even for some clients. But having the ability to bring in growth within the smart beta portfolio, the ability to short bonds based on Harvey's research, and then how to have a multi-asset structure that can go long, short, equities, commodities, currencies, but being able to discern the market, not with the academic ratios that our other partners bring, but looking at the news, which moves markets. As you look over the summer holidays and meet with your family, friends, your clients, do you talk about stock markets and markets understanding academic ratios, or do you talk about it with the news? Probably the news. So you see the diversity of the portfolio that this brings. And you can see actually as of May 1st, the strength of the product returns. Again, our goal is 5-6% product returns. That's our goal. However, you see when the S&P zigs, this for sure is zagging really well, which we're really, really glad to see across our product lines. So just to kind of give you a sense of Ronnie Sadka and the MediaStat Index, the ability to navigate news. This is a team that's been around for over 15 years that daily now is recording over millions of articles a day, and they're navigating what are key narratives that are what we call evergreen. Trade tensions, pandemic, recessions. These are the things that we're talking about today that, as Mark Twain says, history doesn't repeat itself, but it rhymes. So sometimes these concepts go in and out of favor, but they come in, they come out. And how can we capture markets based on reading the news using the intellectual navigation innovation of the Ronnie's team at Market Media Stats? Just to show an example, how COVID, when many of the strategies suffered, this captured 11%. When we had the worst interest rates and inflation, how this was actually prepared because it read the news. And then during the worst equity and bond market sell-off, to continue to do so well because it's read the news to capture the right concepts. So we're not here to show 23% product returns. We're trying to show a 5-6% return. But when you bring in the work of a Harvey Sadka, right, that these returns that show the complementary nature, it allows us then to really asset allocate and meet the advisor where they're at. So to close, the ability to have an asset allocation model using index standard. I urge you definitely look at index standard and then to think about how to anchor an academic portfolio with an S&P 500 distance stabilizer allocation, depending on the comfort of the client. The client just wants S&P. They don't necessarily want the academic portfolio. You have the leading allocation to stabilizer in the market. But if they want to have a concern about how to generate returns, if the S&P is down for years at a time, you know that you have some of the brightest and most legendary financial academics in the market driving commitment to live performance, to providing that complement to the S&P. So with that, I really want to thank you for your time today. and can open it up here.
That's awesome, Tom. Thank you so much. And if I could just add, you know, the BCA product with the academic portfolios and now with the distance stabilizer really an all-in-one solution. You know, Tom, I've heard you tell the story a number of times. You get pitched different index ideas from banks all the time. And what many folks don't realize is many of these indexes that are in products that I won't name the carriers, but a lot of the carriers that we all know, they are built looking backwards. They are built with an eye towards how does it illustrate? And that's not the game that the folks at Annexus play, right? We don't have a time machine. None of our clients have a time machine. We can't go back and live in the past. In the BCA product, with the opportunity to access the brightest minds in the industry, with the most innovative S&P focused strategy in the industry, really gives you a leg up on any competitor that might be pitching any other product out there. A few months ago, probably 2 months ago, I had an opportunity to sit next to Ronnie Sadka at dinner. And quite frankly, I was blown away. I couldn't focus on my meal, just hearing how he views things differently. Folks, indexing does not have to be overcomplicated, but it certainly should not be simplified. Um, the ability in BCA to combine the academic portfolios in minds with this distance stabilizer really, I think, is the magic sauce in our industry. So, Tom, thank you for taking time to touch base on the academic portfolios as well, because I think that when we talk about the distance stabilizer story, we don't want to forget that diversification and asset allocation within a contract is key. It's
Thank you.
absolutely key.
Well said.
And Maureen, did we have any questions from the audience today?
We did, thank you. So this goes to talking about the distance stabilizer. Is it limited to the BCA? Is it able to be used in other product lines? And then that will lead into, is it annuity only?
Yeah, no, great question, Maureen. So we see that the S&P distance stabilizer is the best S&P design in the market. That something that we've never done in Annexus, we're actually putting on all of our products. So it'll be it's currently, as I mentioned, on the North American Secure Horizon suite, which again, our retirement readiness rider, the accelerator there. It's also going to be added within the Nationwide family this summer. You are right. You're going to see it on the Nationwide New Heights IUL for those right life business. And you will eventually see it on the Nationwide New Heights Select FIA, including probably backbook business. So more to come there as well. So
Awesome. Tom, I actually had, I'm sorry to interrupt, Maureen. I had one question. You know, I get this all the time with cap strategies. You know, there's lots of caps out there offering a 10 or a 10.5% cap 1 year on the S&P. And we talked a little bit about the renewal rate integrity and how, you know, that cap's going to walk down. Looking at volatility, option pricing, the environment today, if an insurance carrier were going to be offering a cap with a real strong likelihood of stability, where would that cap be? Like,
I
what's
mean,
the range?
rates have gone up about 8, I would say.
Okay. Okay.
Yeah, so 8, 7.5, 8. On a bonus product, obviously, it's going to be a lot lower.
Right.
You know, you might be in the fours, honestly. So yeah, you're right, Eric. When you see a double-digit cap, I'd run away
Thank you.
because the odds are you can't afford that. And what they're doing is they're trying to get you in as a teaser rate, and then you're stuck in the Roach Motel. And it's interesting sometimes where you have insurance companies try to justify that, like they, oh well, we need to be profitable. Oh, we didn't think option costs were going to go up in price. Well, you should price with the efficacy of how to have at least a stable hedge budget during the surrender period. That's what we do at Annexus, and that's really why we haven't till now had an S&P deny, because it wasn't competitive. We weren't going to do a teaser rate. We weren't going to come out and do that. We've demonstrated that what we call hedge budget commitment, and what you really want to say is participation rate stability, which we're now able to bring here as we've demonstrated with academic and smart beta.
Sure. That's awesome.
So Maureen, was there another question?
Yeah, so going back to the different products and availability, is it also available with things like the FER, FER Max?
Yeah, this is completely on for new business on all of our BCA 2.0 and Velocity FIA. And you're absolutely right. That you have the ability with the product, as much as we value the accumulation engine, it's really important to work with your sales director and your marketer to step back and think about, what is your RMD solution? What is your legacy planning solution? If you can't get underwritten for life insurance, why aren't you using that FER or Max product? Why, when you think about a bonus, right? And we've had this great retirement refinance, and if you have a policy a few years old, to think that you could get on a 10-year product a 14% bonus, and for 85 basis point fee, get 100% upside to the stabilizer. That's pretty powerful, right? The cash value is huge. So we definitely would encourage you to think about the other key features of financial planning on our product lines.
Yeah, I mean, a perfect segue. That's a great segue to what I wanted to mention. There's so many carriers out there, all with their products, and the advisors on the call and anyone that might be watching the replay, not all annuity situations and client circumstances are the same. And so one of the challenges many advisors articulate to me is trying to figure out, which product when or which carrier when. The nice thing with the folks at Nexus have done is that they've really identified all of the different segments where annuities might fit: legacy, guaranteed lifetime income, safe accumulation, planning for long-term care expenses, and some innovative things that you can't get elsewhere, like dealing with the potential cut in Social Security, right? And so they've identified all of these different circumstances in which clients might be facing some challenges, and they've created a suite of products with some of the preeminent carriers in the industry so that you have one place where you can deal with all client circumstances. When you couple that with the breadth of knowledge and the index intelligence that's available inside of all of the solutions, quite frankly, regardless of what case you're working on, you really don't ever have to stray outside of the Nexus family. And the advisors that are taking their business from X to X plus 10 or 20 or 30 or 40% are embracing that and not spreadsheeting products. Folks, don't spreadsheet products. Don't look at backtesting as your primary decision maker in which product to use, right? Let's look forward, and let's pick the innovative products that can solve for problems better than any other product in the industry. And at DMI, we believe that it's the Nexus suite of products. So,
Appreciate that.
Glenn, I appreciate you putting my contact information on the screen. For anyone that has any questions, either reach out to your existing DMI annuity VP if you're working with us currently. If not, please reach out to myself. My contact information is on the screen. You can take a picture of that QR code. All of my contact information will be saved to your phone. At the end of the day, all we can ask is the opportunity to have a conversation. Let's learn about your practice, find ways in which we can improve client situations using these innovative strategies that our friends at Nexus have created for us. And ultimately, we'll create better opportunities and solutions for clients and help you grow your practice. We're trying to go 10x on a year-to-year basis, and we believe that with the Nexus products that we have available, we can help you 10x your business. So we are here to help. We're only a phone call away, and we'd love an opportunity to work with each and every one of you.
There you have it. I can't say it any better. So, Eric, thank you so much. And Tom, it's great to have the index engineer, actually on the presentation today. So, this doesn't happen very often for us. So, we really appreciate you taking the time out. I think it says a lot about our relationship and the support that we get. So, when you call Eric, don't forget that he's supported with this great Nexus team. So. Thanks again, Tom.
No, it's my pleasure. I'm really grateful to be invited and your commitment to really highlight what the power of these can do within a portfolio. And we do value the partnership.
Appreciate you.
Long term.
And for everybody that attended today, thank you for being here. And we will see you on the next one. And everybody enjoy the rest of your Wednesday.
Thank you.
Thank you so
Thank
much.
you.
Ciao, guys.